Welcome to Infinity Learning Space, and in this video we are going to be introduced to the world of accounting. Right. So first, before we learn what accounting is, we need to understand why learning accounting is important. Right. So I would say accounting is a skill or a knowledge that you need to have if you want a career in anything to do with business and management. So whether you want to be an accountant, an investment banker, a finance manager, even a marketeer, HR manager or a production manager, you need to understand accounting. So if you want a career in business management, you need to understand accounting. And accounting is not just for accountants and finance managers. Even people like marketeers and HR managers need to have a basic understanding of accounting in order to be successful in their career. Right. So in this video, we are going to learn what exactly accounting is, the importance of accounting, uses of financial statements, what financial statements are, and the regulatory framework that governs how we prepare financial statements. Right. First, let's see what exactly accounting is. So now we know a business is any activity that produces a good or service. We know humans satisfy their unlimited wants by consuming goods and services. And a business is any activity that produces a good or service. For a business to produce goods and services, the business needs to enter into transactions with other parties. For example, if you take a wooden furniture manufacturer, that business needs to buy wood, that business needs to buy paint and other inputs for the production process. At the same time, the business needs to hire employees and pay them salaries to convert all those inputs into the wooden furniture. And then lastly, the wooden furniture has to be sold to customers. So buying woods, paying salaries and selling the finished product to customers are all transactions entered into by that business in producing a good or service. Right. Then what accounting does is, accounting records, summarizes and analyzes all those transactions a business enters into. So the financial data, more specifically the financial data created by those transactions a business enters into, will be recorded, summarized and analyzed through the process of accounting. So that's what accounting is. It's about recording, summarizing and analyzing transactions entered into by a business. That's the most simple definition of an accounting process. So you can see on the screen, financial accounting is a way of recording, analyzing and summarizing financial data. And what is this financial data? It's simply the transactions carried out by a business, like purchase of goods, sale of goods and payment of expenses. So again, accounting is about recording, summarizing and analyzing transactions entered into by a business. Right. Now in this diagram, we can see, like I said, financial accounting is about recording, summarizing and analyzing transactions. Then after we have recorded, summarized and analyzed our transactions, the financial data related to those transactions, finally we prepare financial statements. We prepare a set of financial statements, and I'm sure all of you are very familiar with financial statements already, like the income statement and the balance sheet and the cash flow statement and so on. So at the end of the accounting process, what is created or what is prepared is a set of financial statements. Now naturally your question should be, so why do we have to do all of this? Why do we have to do accounting? Why do we have to prepare financial statements? The reason for that is, a lot of parties, including owners, managers, employees, suppliers, customers, government, banks, need to make decisions related to the business. And to make those decisions, they need information about the business. So a lot of parties need to make decisions related to the business. And to make those decisions, they need a lot of information about the business. And all that information needed by all those parties is provided by financial statements. Most of the information, especially information about the financial performance, financial position of a business, will be provided by the financial statements, which then all those parties can use to make economic decisions. So financial statements are important because a lot of parties, like I said, owners, managers and so on, rely on those financial statements in order to make economic decisions. Right. So later on we will see the kind of economic decisions made by all those different stakeholders or different parties who use the financial statements. For the time being, all you need to understand is we need to do accounting because the information prepared through the accounting process in the form of financial statements will be used by a lot of parties to make economic decisions. Right. So same thing. Another important thing you need to understand here is that why it is important to do accounting properly instead of just doing accounting. Why is it important to do accounting properly? Why is it important to prepare a set of financial statements that give a true and fair view that is correct, that is not misleading? It's all because I told you, you need the financial statements to make economic decisions. But the quality of those economic decisions depend on the quality of information provided by the financial statements. So if the financial statements provide good information, high quality information that is correct, that is accurate, that does not give a misleading picture, then the decisions taken by the users based on those financial statements will also be correct. They will also be high quality decisions. On the other hand, if the financial statements give a false picture about the business, if the financial statements are misleading, if they are not correct, then the decisions taken by the users based on those financial statements will also be the wrong decisions. They will be bad quality decisions. Right. So you can see here, good quality information will result in good quality decisions. Similarly, bad quality information will result in bad quality decisions. So that's a very famous phrase that says garbage in, garbage out, right? So if you give bad information, what comes out, the decisions that are made are also bad. Garbage in, garbage out. That's why we have to make sure the information given in the financial statements are high quality, they are correct, so that the decisions based on those financial statements will also be correct. So that's why it's important to make sure the accounting process and finally the financial statements themselves are of high quality, they are correctly done according to accounting standards and other rules and regulations. Right. Then another interesting definition of accounting is this definition given by Mr. Warren Buffett. Now, who is Mr. Warren Buffett? I think he's someone all of us should know. Mr. Warren Buffett is the 7th richest person in the world right now. He is the CEO and chairman of a company called Berkshire Hathaway, right? It's the 8th largest company in the world. So it's a very big company, and Mr. Warren Buffett is often identified as one of the most successful investors in the world. So Mr. Warren Buffett is a proponent or a supporter of accounting. I remember I watched an interview of Mr. Warren Buffett, and in that the interviewer asked Mr. Warren Buffett, if you had to advise students on what subject they need to do for their degree, what would it be? And Mr. Warren Buffett's answer was, all students, all business management students should study accounting, because all the other skills and knowledge areas can be obtained through experience, but accounting is really important. It's important that you study it, no matter whether you're going to be an accountant or a marketing manager. Right. So Mr. Warren Buffett defines accounting as the language of business. Now, what do you mean by that? We know now, if you and I want to communicate, we can use Sinhala, Tamil, or even English, right? So that's how we communicate. The language we use to communicate with humans is, in Sri Lanka, of course, Sinhala, Tamil, or English. Now, when a business wants to communicate its financial performance, when a business wants to communicate the value of its asset, the amount of profit generated by the business in a particular year, and so on, the business needs a language.
Hello future chartered accountants. අද අපි ඉන්ෆිනිටි වෙතින් ඕගොල්ලොන්ට ඕගොල්ලොන්ගේ chartered accountancy ඉහනේ සැබෑ කරගන්න නව අඩි තාලමක් යොදවනවා. right? We are planning on building up something new for you all to make sure that you achieve your chartered accountancy dream. ඕගොල්ලෝ chartered accountant කෙනෙක් වෙන path එක දන්නවද? Step number 1. ඕගොල්ලොන්ට A-level වලට minimum S3ක් හරි නැත්නම් AAT complete කරලා හරි ඕගොල්ලන්ට මේක පටන් ගන්න පුළුවන්. Step number 2. ඕගොල්ලෝ ඊට පස්සේ පටන් ගන්නවා business level කියන අධ්‍යයනය. ඒකෙදි ඕගොල්ලොන්ට කොටස් දෙකක් වැටෙනවා. එහෙනම් business level 1 සහ business level 2. මෙතනදී ඔයගොල්ලන්ට business level 1 and business level 2 එකට ඔයගොල්ලන්ට stages 4ක් වැටෙනවා. නැත්නම් subjects 8ක් වැටෙනවා. Step number 3 and step number 4. මේල corporate level and strategic level. මේකදී ඔයගොල්ලන්ට corporate level වලදී subjects 4ක් තියෙනවා. ඒ වගේම strategic level එකේදීත් subjects 4ක් තියෙනවා. Step number 5. මේක තමයි ඔයාලගේ last stage එක. නැත්නම් SL5 case study එක. මෙතනදී ඔයගොල්ලන්ට පොඩි task එකක් තියෙනවා. ඒ මොකද්ද? ඕගොල්ලන්ට ඕගොල්ලෝ ස්ටඩි කරන සබ්ජෙක්ට් එකේ ඕගොල්ලන්ට ස්ටඩි කරන්න ලෙක්චරර්ව චූස් කරන්න පුළුවන්. right? එතකොට ඕගොල්ලන්ට මේ අපේ Infinity YouTube channel එකේ අපේ modules හැම එකේම lecturers-ලා introduction sessions කරලා තියෙනවා. right? ඕගොල්ලෝ අපේ page එකට ගියොත් ඕගොල්ලන්ට හැම module එකේම introduction sessions බලා ගන්න පුළුවන්. Why do we do that? BL වලට සෑහෙන ළමයි ප්‍රතිශතයක් join වුණත් corporate level and strategic level continue කරන ළමයි ප්‍රමාණය ඉතාමත් අඩුයි. ඒ කියන්නේ chartered සිහිනය කරා යන ප්‍රතිශතය සෑහෙන ප්‍රමාණයක් අඩුයි. ඒක නිසා තමයි ඔයගොල්ලන්ට strong foundation එකකින් පස්සේ ඔයගොල්ලන්ට corporate level සහ strategic level වල හොඳ ආරම්භයක් ගන්න අපි students ලගේ පැත්ත බලලා අපේ lecturers-ලා ඔයගොල්ලන්ට අපේ YouTube channel එකේ introduction sessions ටික mention කරලා තියෙනවා. So, in our channel we support all the levels as well as we guide them to be all-rounders in businesses as well by giving them inspirational thoughts and knowledge on future skills. One thought for you. You wake up every day to get better today than yesterday. You try to reach your full potential by getting better every day. And that's the question for you.
And that language is accounting. Because the financial performance and the financial position of a business can be understood, can be identified through the financial statements. And financial statements, we know, is the end result of the accounting process. So simply, accounting is the language that a business can use to communicate about its performance and position. So that's why Mr. Warren Buffett has said that accounting is the language of business. So from all of this, I hope you understand the importance of learning accounting. Then I told you financial statements are relied on by a large number of users, a large number of parties to make economic decisions. Right. So let's see who some of those users of financial statements are, who rely on the financial statements to make economic decisions. We'll start off with managers or the board of directors, right? We know a business, especially a company, is owned by its shareholders or by its owners. But the management, the running of the business on a day-to-day basis will be transferred to the managers or the board of directors. So they need information in order to make decisions about how to manage the business and how to run the business. They want to see how the business has performed in the previous year to decide whether they need to change their strategy, whether they need to do something different. So they need a lot of information to make decisions about management of the company, and that information is provided by the financial statements. Then owners and the shareholders. Owners, even though normally they own a business, they will not participate in managing the business, especially in a company. So then the owners need some sort of information to evaluate whether these managers are doing their job properly. They need information to evaluate the performance of the managers, and the way the owners can evaluate the performance of the managers is by checking the performance of the business itself, which is communicated through the financial statements. Then owners also need information to make decisions like whether to sell their shares in the company or whether to invest more money into the company. They will want to know how much profit the company has generated during the year, and as a result how much profit that they can take out in the form of dividends, or a profit payment. Then customers and suppliers, right? So if you take a supplier, especially credit suppliers, they will be interested in the company's ability to pay back the money owed to them. So when a business buys goods on credit from a supplier, obviously the supplier is going to worry about the company's ability to pay back that money. So then for suppliers to assess or to check whether a company will be able to pay back that money, suppliers can look at the financial statements, right? Similarly, customers will also want to do business with companies that can provide them a secure line of business, right? So if a customer is going to buy a product or enter into a contract with a business, the customer will want to make sure it's a supplier to the customer. The business will be a supplier, so the customer will want to make sure that the business or that supplier is secure and the supplier will be there for a long period of time, because customers will not want to do business with other businesses that will not be there in the long term. So all that information is again provided by the financial statements. Then analysts and advisors. Now these are parties like stockbrokers and credit rating agencies. So these are parties that give advice to their clients, and for them to give advice to their client, they need information which is provided by the financial statements. Now if you take a stockbroker needs to advise his or her clients on what kind of shares to buy, which company shares to buy, and all that advice is based on information provided through the financial statements of those companies, right? Then lenders. So mainly parties who provide loans to the business, like banks, right? So when a bank gives a loan to a business, the bank will obviously first want to evaluate whether the business will be able to pay back that loan. So the first thing that a bank will want when a business goes to take a bank loan will be the set of financial statements, to go through them and to check whether the company has the ability to pay back the loan. Then the government will be interested in the financial statements, because they need to decide how much tax to charge, how much sales tax to charge, how much income tax to charge, and so on. Then the government will also want to make sure the business is complying with its rules and regulations, and that also can be kind of identified through the financial statements. Then the public. Now the public is affected by a business in many ways. For example, a business provides employment opportunities to the individuals in the community. So obviously the public will want to make sure that the business is going to be there for a long period. It will not be closed down, because if it closes down, all those people will lose their jobs. At the same time, the public will also be interested in the impact of the business on the environment. Then employees will also be interested in financial statements, because their salaries and wages, their bonuses, their career progression all depend on the financial performance and the financial position of a business, all of which is communicated through the financial statements, right? So you can see all these users rely on financial statements in order to make economic decisions. For example, like I said, owners will look at financial statements to decide whether to sell their shares in a company or to invest more money into the company. Then the employees will look at financial statements to check whether they should continue to do their job at this particular company, or whether they should move to another job with another company. Then bank will decide whether to give a loan or not to a company based on the financial performance and financial position as shown in the financial statements, right? So then we are going to see the difference between internal reporting and external reporting, right? So by the way, now here we looked at the word financial accounting. Another word that we will come across is financial reporting. It means the same thing. So financial accounting and financial reporting more or less mean the same thing, right? So internal reporting, right? So we identified there are multiple users of financial statements, right? Another verb that we can use to describe all these parties is stakeholders. A stakeholder is any party that is interested in a business. So out of all these stakeholders, there are some stakeholders who are within the business itself, who are within the boundaries of the business. And those stakeholders are the managers or the board of directors and the employees. So only these two stakeholders are within the business itself. All the other stakeholders are outside the business. Now keep in mind, even the owners are considered to be outside the business. Right. So the financial information that is given to internal stakeholders is called internal reporting. Any financial information given to internal stakeholders is called internal reporting. Managers need the most information to help them make their planning and control decisions. They have access to information about the business because they are able to demand whatever internal reports they require. So out of the internal stakeholders, managers or the board of directors will be the most important, and they need probably the most amount of information about the business because they have to make decisions on a day-to-day basis on how to manage the business and how to run it, right? But they are also able to demand any information that they need regarding the business. So only managers can actually demand any kind of information that they need about the business. Other stakeholders can't really demand any particular type of information that they want. They have to be happy with whatever is given to them through the financial statements and other types of reporting. But the managers, they can demand for any kind of information about the business. Right. So the most common types of internal reports are the budgets and the management accounts. So managers, more than on financial statements, rely on the budgets and the management accounts. What are budgets? Budgets are basically managers' estimates or predictions about the cost and revenues of the business in a future period. For example, the managers can make a budget for the next year. In the budget, it will have information about the estimated cost and revenue and the resultant profit for the next year. So that's a budget. Then management accounts show the actual performance compared to budget and will also include commentary for significant variances to budget. So management accounts, on the other hand, will show the actual performance and compare it to the budget and give commentary or give an idea about the variances in actual performance compared to the budget. And management accounts and budgets, that is internal reporting, is not normally prepared based on accounting standards. So based on your existing level of knowledge on accounting, we know financial statements especially are prepared using accounting standards, right? But management accounts and budgets, keep in mind, are not prepared based on accounting standards like SLFRS and LKS, and they also do not have a particular format. So the management accounts of one company can be completely different to the management accounts of another company. They will have completely different formats. They will have different information. They will not be comparable like financial statements of two companies. We know financial statements of two companies can be compared to a certain extent. But management accounts, because they are not prepared based on a particular format, will not be comparable like that. Then broadly speaking, management accounting is concerned with providing financial information to help plan for the future, right? So in management accounting, the focus is on providing information so that the managers can make decisions about the future. Whereas in financial accounting, it's more concerned about historical financial information. In financial accounting, we look at the historical performance of a business. Now, just based on this, you can see that accounting can be broadly classified into management accounting and financial accounting. And the focus of this subject is on financial accounting, not management accounting, right? But just this is given just for us to get an idea about what management accounts are, right? Then the other internal stakeholder is employees. In some companies, employees are given specially prepared reports with financial information called employee reports. Now, this is very common in banks, right? In large organizations like banks, employees get like a monthly report about the performance of the company and how they are achieving their targets. For example, the sales staff can get a report on their progress on achieving sales targets, right? So, employee reports will contain financial information given to employees. Then external reporting, this is where we are going to pay much of our attention. External reporting is basically all the financial information given to all other stakeholders other than the managers and the employees. So, the most common type of external reporting is financial statements, right? So, financial statements are given to a large number of users, right? It's not specifically for managers or employees. Of course, managers and employees can also rely on the financial statements, but they are not specifically designed for the managers and employees, because managers and employees need much more information than what is given in the financial statements. But financial statements cater, or they provide the information required by a large number of users. Unlike management accounts and budgets, financial statements are prepared based on accounting standards, right? So, we already learned that. Unlike management accounts, when you prepare financial statements, when you prepare a balance sheet, an income statement, a cash flow statement and so on, we need to make sure we follow the requirements of accounting standards like SLFRS and LKS, right? Then the next thing we are going to learn is types of business entities. Now, why are we all of a sudden learning about types of business entities? We are learning this because the accounting requirements, decisions about whether to prepare financial statements, whether to have the financial statements audited, whether the financial statements should be prepared according to accounting standards, so on. Decisions like those will be decided on the type of business organization. Because now, simply put, a limited liability company is required by the Companies Act to prepare financial statements, but that is not really a requirement for a sole trader, right? So, the accounting requirements, how different businesses should account, how they should maintain accounting records and prepare financial statements, and whether they should get those financial statements audited, depend on the type of business organization. So, that is why we are going to learn the main 4 types of business organizations. So, most business organizations are of course profit motivated. They exist in order to generate a profit for their owners, but not all business organizations are like that. We get non-profit making entities. These are charities and societies where the objective is not really to generate profit, but to serve the community, to protect the environment, right? So, their objectives are not really profit motivated. We will look at the first 3 and non-profit making entities. Of course, we already know what they are, and non-profit making entities can prepare financial statements, but most of the accounting standards we are going to learn will apply to these 3 types of business entities, not for non-profit making entities. Of course, like I said, non-profit making entities can also make financial statements, but some accounting standards do not apply to them because they are not profit motivated, right? So, first, a sole tradership, right? This is the most common type of business organization, right? The grocery shop near your house, right? The uncle on the road selling cuddler or toys or anything, right? And then the small bakery in your town. All those businesses are sole traderships. So, sole tradership is the most common type of business you will see in the world. A sole tradership, like the name suggests, is owned and operated by one individual. So, sole means one individual. So, it is owned and operated by one individual. Normally what happens is an entrepreneur will decide to start a business and then start the business and do everything on his or her own. So, then it becomes a sole tradership. But of course, just because it says it's owned and operated by one individual, it does not mean the owner will not have any employees. Of course, in a sole tradership also, there can be employees. But most of the key decisions will be taken by the founder of the business. There will be one key person and he will make all the key decisions. No legal difference between the owner and the business. Right. So sole traderships do not have a legal personality. That means for legal purposes, in front of the law, right, for legal purposes, the owner and the business are not two separate legal personalities, right? So the business cannot buy assets in its own name. The business cannot enter into contracts in its own name. The business cannot take legal actions in its own name, because the business and the owner are the same. Everything has to be, all legal matters have to be done in the name of the owner. So when the business buys assets for business purposes, the assets actually are legally owned by the owner, because the business is not a legal personality. The business and the owner are the same. So the assets will be bought in the name of the owner. Contracts will be entered into in the name of the owner. Right. Then, however, when doing accounts, business entity concept still holds. Now, even though legally speaking, owner and the business are not separate, they are both the same. For accounting, right, we follow something called the business entity concept. That means, for accounting, when we are maintaining the accounting records for the business, it should only include transactions entered into by the business. It should not have personal transactions of the owner. So if the owner, for an example, pays for the owner's personal electricity bill using the owner's personal money, that transaction will not be entered into the accounting records of the business, because for accounting purposes, the business and the owner are separate. For legal purposes, they are not separate, but for accounting, the transactions of the business will be recorded separately from the transactions of the owner. So personal transactions of the owner will not be recorded in the accounting records of the business. Owner has unlimited liability. So we just learned that owner and the business are the same, right? So if the owner takes a loan for business purposes, right, and then later subsequently finds out that the assets of the business are not enough to pay back the loan. So that means the owner has to sacrifice his personal assets in order to pay back the loan. Even though the loan was taken for business purposes, the owner has to sacrifice his or her personal assets in order to pay back the loan, because actually the loan is taken in the name of the owner, because there is nothing called the business for legal purposes. So the owner has unlimited liability for the business loans. So if something happens and the business doesn't have enough assets, owner will have to use his own personal assets to pay back loans and other debts. Right. We'll go through a couple of advantages of a sole proprietorship or a sole tradership. So sole proprietorship is another name for a sole tradership. Right. So the first one is limited paperwork and less cost in establishing this type of structure. So the reason why sole tradership is the most common type of business organization in the world is because it's very easy to start a sole tradership. All you need to do is just start producing and selling a good or service. You don't need to fill forms, you don't need to register or things like that. Of course, later on you might have to register, right? But just to start, you don't really need to fill forms or pay fees or anything like that. It's very easy to start. Owner has complete control over the business. Now, the owner of the business will have complete control of the business. Everything will be done according to the way the owner wants. Owner is entitled to profits and the ownership of the assets. So, since the assets are bought in the name of the owner, all the assets belong to the owner, and all the profits generated by the business will also go to the owner. Owner does not have to share it with anyone else. Less stringent reporting obligations compared with other business structures. No requirement to make financial accounts publicly available. No audit requirement. So, for sole traderships, the requirement to maintain financial statements and to have them audited will not apply. Financial statements of sole traderships do not have to be made public, and actually the financial sole traders are not even required to prepare financial statements under the Companies Act, but they might have to prepare financial statements for tax purposes, right? So the profit generated by a sole tradership will be taxed under the personal income tax of the owner, and to calculate the business income, the owner will have to prepare a set of financial statements, right? But there's no need to get them audited. Can be highly flexible, right? So since it's only one person, decisions can be made quickly and the owner can respond very quickly to changes in the environment. Then disadvantages. Owner is personally liable for all debts, unlimited liability. So that's what I explained before. When the assets of the business are not enough to pay back the loans of the business, owner will have to bring in his personal assets to pay back those loans. So there's unlimited liability for the owner. Large sums of capital are less likely to be available to a sole proprietor, leading to reliance on overdrafts and personal savings, right? So since a sole tradership is based on one person, the amount of money that can be invested into a sole tradership will be very minimal, because it's just personal savings of one individual and sometimes money given by his or her family members. But the amount of capital that can be invested, the amount of money that can be invested into the business will be limited compared to, for example, a company, because in a company you can issue shares in order to raise money to invest in the company. May lead to long working hours without the normal employee recreation leave and other benefits. So especially when you start a sole tradership, when you start a business on your own, you will have to put in a lot of effort, time and your personal savings to make it successful. May be issues of continuity of business in the event of death or illness of the owner. So sole traderships do not have something called perpetual succession, right? So perpetual succession is not something that sole traderships have. What that means is, when the owner dies or when the owner falls sick, right, the business will come to an end, right? The assets of the business will have to be sold and the liabilities settled. But of course, certain businesses, certain sole traderships can be continued by, let's say, a son or a daughter of the owner, of the original founder. But then it is still not the same business as the original business, because now the business is that sons or daughters and all the transactions entered into are in the name of that son or daughter, right? So when son or daughter takes over the business, it's, even though it looks like the same business, it's not, it's a completely new business, right? Even the legal contracts, legal transactions will be in the name of the son or daughter now, not in the name of the father who was the founder of the business. So perpetual succession means a situation in which the death or the departure of owners will not affect the continuity of the business. Now that's what we see in a company. In a company, the death of a shareholder is not going to affect the existence of the company, because someone else will become the shareholder, right? And if one shareholder sells his or her shares to another party, that's also fine, because the business will still continue. So a company theoretically can continue forever. There's something called perpetual succession, but that is not there in a sole tradership. Right, so the next type of business organization we are going to learn is a partnership. A partnership is able to overcome some of the advantages and drawbacks of a sole tradership. In a partnership, two or more individuals come together to start a business, and those individuals will be called partners and the business will be called a partnership. Similar to sole tradership, in a partnership also, there's no difference, there's no legal difference between the business and the partners. So for legal purposes, the business and the partners are one and the same. The partnership does not have a legal personality separated from the partners or from the owners. However, for accounting purposes, the business entity concept will be followed, meaning the transactions of the partnership will be recorded separately from the personal transactions of the partners. Then partners are also jointly and individually liable for losses and liabilities of the business. They are unlimitedly liable for losses and liabilities of the business. So again, similar to a sole tradership, partners also have unlimited liability for the loans taken by the partnership. But here they are both jointly and individually unlimitedly liable, meaning, right, the debts of the partnership, the loans of the partnership need to be repaid by all the partners either together or individually. For an example, let's say these three partners take a loan for the partnership business, right? If all these three partners are alive, if they have assets, right, all three need to contribute towards repayment of that loan. But let's say this partner goes bankrupt, this partner loses all his assets, so this partner no longer has any assets to contribute to repay that loan. So that does not mean these two partners don't have to repay the loan fully. Even though one of the partners is no longer in the picture, these two partners, the remaining partners, need to make sure they contribute their personal assets to repay the loan of the partnership completely. So if the loan is for, let's say, 1,000 rupees, right, these two partners cannot say, no, I'm only going to pay 333 and I'm going to pay 333, right? They, both of them together need to somehow pay that 1,000. So they are both collectively and individually liable for the loans of the partnership. Partnership generally have a contract called the partnership agreement. So when it's a partnership, normally there will be a contract between the partners, and that contract is called the partnership agreement. In the partnership agreement, it will clearly say the responsibilities of the different partners, how much capital they need to invest in the partnership, how much profit that they can take out, the salaries that they are entitled to, and so many other terms and conditions of the partnership. I'll go back and explain this a little bit more again. So what this means is all the partners need to ensure that the loans of the partnership is somehow paid. Now here, even though the loan was for 1,000, right, each partner cannot say that each one will pay 333, right? If this partner is no longer there, meaning if this partner doesn't have any assets, if this partner has already gone bankrupt, then the other two partners still need to pay back the entire loan, 500, right? Let's say this partner only has 200, then this partner has to pay the entire balance of 800. So if this partner is not there and this partner only has assets worth 200, the remaining partner needs to pay the balance amount of 800. So they are both collectively as well as individually liable to pay the loans of the partnership. Then a couple of advantages. So similar to a sole tradership, less stringent, meaning less strict reporting obligations, no requirement to make the financial accounts publicly available, no audit requirement. Additional capital can be raised because more people are investing in the business. Now, unlike in a sole tradership where only the owner's capital, owner's personal savings will be invested in the business, in a partnership, because there will be more than one person, there will be more capital to start the business. Division of roles and responsibilities and an increased skill set. So you can bring partners with different skill set to manage the business. For example, one partner can have expertise in finance, so he or she can look after finance matters. Another partner can have expertise in marketing, so he or she can look after marketing part of the business. So you can bring people with different skill sets to start the business and run the business. Sharing of risks and losses between more people. So if the partnership incurs a loss, it will be shared between two or more individuals, unlike in a sole tradership where the entire loss has to be faced by the founder or by the single owner, right, the sole trader. So some of the disadvantages: partners are joint and individually unlimitedly liable for all debts. So we had a look at that. there are costs associated with setting up a partnership agreement. Now, a partnership agreement will normally be a legal document, a written legal document. If that is the case, you will have to pay a lawyer to draft it and to get it ready. So there can be some cost involved in setting up a partnership agreement. There may be issues of continuity of business in the event of death or illness of any of the partners. So again, a partnership also does not have perpetual succession, same as a sole tradership. If one of the partners in a partnership dies or goes bankrupt, right, falls sick, right, then the partnership is effectively over. It has to come to an end. Even though the other two partners decide to continue the business, right, that new business is not the same as the old business. So if there were 3 partners and one partner dies and the other 2 continues it, it's not the same partnership that they are continuing. They have actually entered into a new partnership agreement with just the 2 of them. The original partnership with all 3 partners have terminated. It has terminated. Unless a clause is written into the original agreement, when one partner leaves, the partnership is automatically dissolved. So normally when one partner leaves, right, or dies, right, the partnership has to be closed down. It's dissolved. Of course, if in the partnership agreement it is agreed between the partners that the remaining partners can continue, they can continue, but it's still a new partnership, not the old partnership. And another agreement is required between the existing partners. Slower decision making due to the need for consensus between partners. Now, unlike in a sole tradership where the single owner can make all decisions, in a partnership, all the partners need to come together to make the important decision. So it can take some time. Right. So the last type of business organization we are going to look at is limited liability companies, right? And much of our attention will be here, right? So legally separate from the owners, this is called incorporation. Now, different to both sole traderships and partnership, a limited liability company has a legal personality, right? So it gets a legal personality through this process called incorporation. By incorporating, the limited liability company will have a legal personality. So it can enter into contracts in its own name, right? It can buy assets in its own name. A company can buy assets in its own name, and those assets belong to the company, not to the owners, because the company itself is a legal personality which is recognized by the law. So if the company enters into a contract, it's the company that has entered into a contract, not the owners, right? Shareholders are not personally liable for the debts of the company. Liability of the shareholders is limited to their investment. So shareholders, the owners of a company, owners of a limited liability company, will have limited liability. If something goes wrong and if the assets of the company are not enough to pay back the loans of the company, the shareholders don't have to sacrifice their personal assets to pay the loan back, because the company and the shareholders are separate. So the only thing that the shareholders can lose is the amount of money that they invested in the company. That's it, right? The bank cannot come and take the assets of the shareholders of a limited liability company to repay the bank loans, because the owners, the shareholders and the company are separate. So shareholders' assets will not have to be sacrificed to pay the loans of the company. There's a clear distinction between shareholders and directors of limited companies. Now, unlike in partnerships and sole traderships, where the owners and the managers were more or less the same, meaning owners were also the people who run the business on a day-to-day business. In a limited liability company, the owners, the shareholders and the managers, people who run the business, people who run the business and people who manage the business will be quite different, right? So shareholders are the owners but have limited rights over the day-to-day running of the company. They provide capital and receive a return. So they put the initial capital, they invest money into the company, right? And that's it. They don't participate in day-to-day management of the company. What the shareholders do is they appoint a group of individuals called the directors, the board of directors, in order to manage and run the company. So it's the board of directors who are responsible for managing the company. The board of directors are appointed by the shareholders to run the company on behalf of the shareholders. So all the what shareholders have to do is invest money in the company, and then they can appoint directors to run the company. In practice, they have a great deal of autonomy. Directors are often shareholders. So in most business organizations, right, in most limited liability companies, shareholders will also act as directors, right? But it's possible for a company to have a board of directors who are not shareholders at all, right? But if you have invested a lot of money in a company, you're likely to get yourself appointed as a director, so you can also manage the company. But strictly speaking, the directors and the shareholders are separate. Directors act as agents of the shareholders to manage the company. Right. So some advantages, the most obvious advantage is the fact that shareholders have a limited liability. They do not have to sacrifice their personal assets for the loans of the company. Then limited liability makes raising finance easier, and there is no limit to the number of shareholders, right? So now, because you can issue shares to the public, especially if it's a public company in Sri Lanka, a public limited company, you can raise a lot of capital. And there's no limit to the number of shareholders. If it's a public company, again, there's no limit to the number of shareholders. In Sri Lanka, we have private limited companies and public limited companies. A private limited company can have a maximum of 50 shareholders, whereas a public limited company can have more than 50 shareholders. So if you're a public limited company, there's no limit to the number of shareholders you can have. Just one more point here on the limited liability. Now, if you have a small company, right, a small limited liability company, when you go to take a bank loan, right, the bank will normally ask for a guarantee from the shareholders, a personal guarantee from the shareholders, right? If a big company goes to the bank and asks for a loan, then the bank is not going to ask for a personal guarantee, because the bank has faith that the company will be able to pay back the loan. But because the bank knows in a limited liability company, the bank cannot use the assets of the shareholders. When the bank gives the loan, bank says, no problem, I'll give you the loan, but I also want a personal guarantee from the shareholders. So what happens in a personal guarantee is that shareholders say, I know my liability is limited as a shareholder, but I promise if something goes wrong, I will give my personal assets to repay the loan. That's a personal guarantee, but that is only required sometimes if the bank asks for it. But normally, right, in a limited liability company, shareholders do not have to sacrifice their assets to pay back the loans of the company, right? In certain situations, the bank and other lenders can ask for a personal guarantee as an additional security, right? So just something you need to know. A limited liability company has a separate legal identity from its shareholders. A company therefore continues to exist regardless of the identity of its owners. So there's incorporation, which means the company has a legal personality separate from the legal personalities of the shareholders. It is relatively easy to transfer the shares from one owner to another. There is perpetual succession. So sole traderships and partnerships don't have perpetual succession, but companies do have perpetual succession, because a company, being a separate legal person, is unaffected by the death or departure of its shareholders. It continues in existence no matter how ownership changes between shareholders. So let's say 3 people get together and start a company, and after a year, all 3 shareholders sell their shares to 3 new individuals. But that is not going to affect the existence of the company, because the company is a separate legal personality that will continue to exist regardless of the fact that the ownership of the company has changed, right? So a company has perpetual succession. It will continue forever. Then disadvantages of a limited liability company. Now, if you are a listed limited liability company, a public limited company that is listed on a stock exchange, then it is required for you to publish your financial statements. Your financial statements will be uploaded to Colombo Stock Exchange website for everyone to see. Even your competitors can see your financial statements, so they can see how well you did or how bad you did during the year. Limited liability company financial statements have to comply with legal and accounting requirements. In particular, financial statements have to comply with accounting standards, right? So for limited liability companies, you have to make sure your financial statements are prepared and they are prepared according to accounting standards. Most limited liability companies have to prepare their financial statements according to Sri Lanka accounting standards. Sole proprietors and partnership may comply with accounting standards, example when calculating profits for tax purposes. So even sole traderships and partnership, like I said, even though they are not required to prepare accounts according to the Companies Act, they will still have to prepare accounts for tax purposes according to accounting standards. The financial statements of limited liability companies have to be audited. Another important thing, if you are a limited liability company, you should prepare financial statements, but you should also have those financial statements audited, verified by an independent party, because the financial statements are prepared by the managers and board of directors within a company. A lot of people rely on the financial statement, so there has to be an independent verification. Someone has to double check whether the financial statements have been prepared properly. That's called auditing. It's done by an independent third party audit firm like KPMG, EY, PwC, Deloitte, right? So a company like that will audit the financial statements. For a limited liability company, their financial statements need to be audited, which can be inconvenient, time consuming and expensive, because you have to pay the auditors money to get the financial statements audited. Share issues are regulated by law. For example, it is difficult to reduce share capital, referred to as stated capital in Sri Lanka. Sole proprietors and partnership can increase or decrease capital as and when the owners wish, right? So even though you can issue shares to raise capital, right, issuing shares will still regulated by law. So when you want to issue shares, there are so many rules and regulations you need to follow, right? You might have to publish a document called a prospectus, right? You might have to gazette it, you might have to give public notice, and so many things, so many rules and regulations that need to be followed when you are issuing shares. Similarly, when you want to reduce the amount of share capital, meaning take some of the money invested by the shareholders back, when the shareholders want to take some of the money they invested back, right, there are again other rules and regulations that need to be followed. That will not be there in a sole tradership or in a partnership, because in a sole tradership or a partnership, the sole trader or the partners can simply take whatever the money that they put into the business out from the business. There will not be strict rules and regulations. Right. Then next we are going to look at the financial statements, right? So at the very beginning we learned that the end result of the accounting process is to prepare the financial statement. So what exactly are these financial statements, right? So a set of financial statements comprise of 5 components. A set of financial statements comprise of 5 components, right? So first we have the statement of financial position, which we sometimes call the balance sheet. Then we have the statement of comprehensive income. That can be shown in 2 ways, right? You can show the statement of comprehensive income as a single statement, right? So you show one statement which you will call the statement of profit or loss and other comprehensive income. You can also show your statement of comprehensive income as 2 statements. One statement, that is the statement of profit or loss, that is immediately followed by another statement called the statement of comprehensive income, starting with the profit or loss, right? So I'll show this to you and you will understand it. Then we have the statement of changes in equity, statement of cash flows, and finally accounting policies and explanatory notes. Now this 5th component is very important because most of the information you get in the 4 statements here are summarized. The information you get in these 4 statements is very summarized. All the transactions entered into by business will be recorded, analyzed and summarized in these 4 financial statements. But more detailed information about all the information given in these statements can be obtained through accounting policies and explanatory notes. Now, if you go through the annual report of a company, you will see that these first 4 statements will probably take up the first 10 pages, right? Just 10 pages, and you will get all the 4 statements. But this accounting policies and explanatory notes part will spread from about 50-60 pages, because everything that is summarized here will be explained in detail in accounting policies and explanatory notes. So, it's a very important component in a set of financial statements, right? So, users of financial statements need that additional information given in accounting policies and explanatory notes to better understand these first 4 financial statements, right? So, let's look at the format of a balance sheet, or what we call the statement of financial position. It's better if you can use the name statement of financial position, right? So, you can see it has the assets, right, the equity and the liabilities. So, we know businesses' assets are funded, or the money to buy the assets come from either equity or from liabilities. So, this value will be equal to this value. This value is the addition of equity and liabilities, right? So, the money from equity and liabilities will be used to buy the assets, right? And you can see under assets, it's divided into non-current assets and current assets. So, simply put, non-current assets are assets that are expected to be in the business for more than 12 months. Current assets are assets that are expected to be sold or consumed within 12 months. And same with non-current liabilities and current liabilities. Non-current liabilities are liabilities that are expected to be repaid after 12 months, and current liabilities are liabilities that are expected to be repaid within the next 12 months, within the 12 months after the balance sheet date. Another important point is that the statement of financial position is prepared as at a particular date. This is the value of the assets, equity and liabilities as at this particular date. So, it gives us a snapshot of the financial position of the business, right? So, through the statement of financial position, we get information about the financial position, meaning the value of assets, equity and liabilities as at a particular date, right? Then the statement of comprehensive income, I told you we can present it in 2 ways. The first way is where you have one statement, right? This is one statement which we will call statement of profit or loss and other comprehensive income. First thing is, it's prepared for a particular period. Now here this is for a year, so it's not as at a particular date, it is for a particular period, right? So if it's one statement, you will still have 2 sections, right? The section that starts with revenue and ends with profit for the year, or what we call profit after tax, is the P&L section, or what sometimes we call the income statement. So this is the first section, and that ends with profit for the year. Then the next section called other comprehensive income will start, right? And then finally the addition of profit for the year and whatever other comprehensive income will be equal to total comprehensive income. So when we say total comprehensive income, it includes profit for the year as well as other comprehensive income. It's still one statement, just 2 sections, right? The P&L and the OCI section. Then we can also give the statement of comprehensive income as 2 statements. One statement that only has the P&L part. So this part we have separated and put in a separate statement. It starts with revenue, ends with profit for the year, or what we call profit after tax. Then immediately after that we give the second statement called the statement of comprehensive income for the year ended, right? But what's important is this second statement starts with where the first statement finished. So the first statement finished with this value, and that's the same value we start the second statement with, right? We don't show everything, we just show the last value, put it here. That's the beginning of the second statement. And then we show the other comprehensive income. Then again the total of this plus this will give you the total comprehensive income, right? So when we say total comprehensive income, remember it's profit for the year plus other comprehensive income, right? Okay, so statement of comprehensive income, you can give it in two methods, a single statement, right, this, or two statements, right? Okay, so it's up to the company or it's up to the business to decide which format they want to use. Then we have the statement of changes in equity. So here we have an analysis of different equity components. Now when we say equity, it's not just the money invested in the business by the owners, right? That is only stated capital. But in equity, we get items like revaluation, surplus, retained earnings, and so on. So you will understand these better as we learn more about accounting. Then we have statement of cash flows, right? In the statement of cash flows, we look at cash inflows and outflows during the year. Now, through the statement of profit or loss, right, we find out the amount of profit generated by the business, but we don't know the amount of cash generated by the business. So the details about amount of cash that came into the business and the amount of cash that went out of the business will be given in the statement of cash flows. Statement of cash flows will have three parts: the operating activities, investing activities, and financing activities. So you show all the cash inflows and outflows in the cash flow statement. Now don't worry about these too much, because as we progress, we will learn how to make each of these statements. Right now you need to have a general idea. Right. Then we are going to look at what we call GAAP, or generally accepted accounting principles. Right. Now I told you already, it's very important that we prepare the financial statements properly. Financial statements should not be misleading. They should be correct. They should be fair. They should give a true and fair view. Basically, they need to be prepared properly. So how do we ensure that financial statements are prepared properly? We ensure that the financial statements are prepared properly by following certain rules and regulations when preparing financial statements, right? So all those rules and regulations we follow when preparing the financial statements are called generally accepted accounting principles. All the rules and regulations, including accounting standards, we have to follow when preparing the financial statements are called generally accepted accounting principles, or GAAP, right? GAAP. So in GAAP, right, these items are included like national legislation. Now for companies, the relevant legislation is the Companies Act number 7 of 2007, which requires all companies to prepare financial statements that give a true and fair view of the company's financial position and financial performance. Then there's the Inland Revenue Act number 24 of 2017, which tells you how financial statements need to be prepared for accounting for tax purposes, right? So these are national laws. Then of course, when preparing the financial statements, you need to follow the accounting standards. In Sri Lanka, we follow the Sri Lankan accounting standards, which we call LKSs and SLFRSs. Then if you're a company listed on the stock exchange, you will also have to follow stock exchange requirements. Now in Sri Lanka, we have the Colombo Stock Exchange. So if you're a company listed on the Colombo Stock Exchange, you also have to follow the rules and regulations of the Colombo Stock Exchange. So all these, right, rules and regulations will tell us how to prepare our financial statements, and all of them together are called generally accepted accounting principles, right? So we'll have a look at the accounting standards, right? Perhaps the most important set of guidelines we have to follow when preparing financial statements, right? So much of the syllabus will be on learning different accounting standards, right? So accounting standards for Sri Lanka are issued by the Institute of Chartered Accountants of Sri Lanka. So in the accounting standards, the companies in Sri Lanka, the businesses in Sri Lanka need to follow are issued by the Institute of Chartered Accountants of Sri Lanka, or what we call CASriLanka, right? Now the accounting standards in Sri Lanka are called LKSs and SLFRSs, right? Now LKSs are the accounting standards that were issued some time ago. All the new accounting standards are called SLFRSs. And these LKSs and SLFRSs are all adopted from international accounting standards. So international accounting standards, what we call IASs, right, and IFRSs are issued by an international organization called the International Accounting Standards Board, or the IASB. So International Accounting Standards Board issues IASs and IFRSs, and these international accounting standards are adopted or are taken by the Institute of Chartered Accountants of Sri Lanka. Basically, our accounting standards are copies of IASs and IFRSs. Why are they copies? Because they are copies because over 120 countries in the world, they have developed their accounting standards based on these international accounting standards. So our accounting standards, like I said, are also copies of these international accounting standards. When I say copies, it's not a bad thing, right? It's not like, we say cut, copy, paste. It's not like that, right? The Institute of Chartered Accountants of Sri Lanka take this accounting standard and adopt them, right? So our accounting standards are almost 100% similar to IASs and IFRSs. That's done because, like I said, more than 120 countries in the world follow accounting standards based on IASs and IFRSs. So when companies in Sri Lanka also prepare their financial statements based on the LKSs and SLFRSs, which itself are based on these, right? The financial statements of companies in Sri Lanka are comparable with financial statements of companies in other countries. So when all the companies, all the businesses in the world follow the same set of accounting standards, it increases the comparability of those financial statements. Otherwise, now we can't compare the financial statements prepared in Sri Lanka with the financial statements of a company in, let's say, the UK, right? Because they are prepared on different accounting standards. But now, because we are also following the same accounting standards UK is also following, financial statements for a company in Sri Lanka can be compared with the financial statements for a company in the UK. So that's why more than 120 countries in the world follow almost the same accounting standards, right? Of course, there are certain countries that have their own set of accounting standards which are very different to the IASs and IFRSs. Now, for example, if you take America, right, they have their own set of accounting standards which we call the US GAAP, right? Not just GAAP, the US GAAP, right? So their accounting standards are very different to the IASs and IFRSs. But even the US is slowly changing the accounting standards to match with the international accounting standards. So then the financial statements of companies in the US can be compared with the financial statements of companies in any of those 120 countries that use IASs and IFRSs, right? So Sri Lanka adopts IFRSs and issues them in the form of LKSs and SLFRSs, as it believes that the use of international standards in Sri Lanka will help improve global comparability for Sri Lankan companies, right? Then next we are going to look at some of the limitations of financial information. Now, of course, financial statements, accounting information, right, the financial information is very important to make decisions, but we also have to realize that that information is not perfect, right? We have to be careful when we make decisions. We need to understand the drawbacks and the limitations of the information that we use. So the first one is, financial statements do not provide a full picture of an organization's financial performance and position that the users of financial statements need to make economic decisions. Now, even though financial statements provide a lot of the information that users of financial statements need in order to make decisions, not all the information is provided. Some information like general economic conditions, political events, industry outlook, right, meaning what's happening in the general economy, what's happening in politics, right, what's happening within the industry, information like that will not be given in the financial statements. However, they are very important to make decisions. So because of that, users have to rely on the management commentary, sustainability reports and integrated reports. So in addition to the financial statements, now most companies in their annual report will also give management commentary. That's where the managers comment on the performance of the company. The managers give their thoughts on the performance of the industry, the economy in general, things like that. So then the users of financial statements can understand them better. Then sustainability reports show the impact of the business on the environment, on the society, and not just in monetary terms. Integrated report is similar. It also shows the impact of the business on other areas that are not shown by the financial statements. So additional information or supplementary information given in management commentary, sustainability reports and integrated reports will help users of financial statements make better decisions. So financial statements on their own are not perfect. We need more information to make the correct decisions. Right, that's the first limitation of financial information. Then not all assets of a business are recognized on the statement of financial position. For example, human resource assets cannot be recognized in financial statements under LKS 38 intangible assets. Now in financial statements we only show assets, right, for which we can give a value, for which we can give a monetary value. So some assets for which we cannot give a monetary value, like the skills and the knowledge of the employees, the brand loyalty, right, the competency of the managers will not be shown in the financial statements, but they are still assets that the business has, but they are not shown in the financial statements. So that's another drawback. This problem can be addressed to a certain extent by providing additional non-financial information, especially through integrated reports. So like I said before, integrated reports not only provide financial information, they also provide non-financial information. They will talk about the assets that the business has that are not shown in the balance sheet, like for example, skills, competencies of employees. Then certain assets are recorded at historical cost, the original cost. For example, property, plant and equipment can be measured at historical cost less accumulated depreciation. This may not accurately reflect the current values, right? Now in accounting, right, if you buy a plot of land that you plan on using, right, a plot of land that you purchase to use and not to resell, right, you will first measure it at cost, right? Of course you can revalue it from time to time, meaning you can update the value of the land from time to time, but it will still be at a revalued amount at a particular date, right? But that does not mean at the balance sheet date, at the date of the financial statement of financial position, that's the value of the land. So for example, in our statement of financial position, if we say the value of land is 100,000 rupees, right, that does not mean we can sell the land for 100,000 rupees on that particular date, right, because that can be the revalued amount from a previous year. Even if it's the value as at the balance sheet date, by the time users get the balance sheet, by the time users get the financial statements, the value could have changed, right? So the information, especially the value of assets and liabilities you see in the statement of financial position can be different to what they are actually. Financial statements of a company are not necessarily comparable with other companies internationally due to different accounting standards used. However, the use of IFRS helps to improve global comparability of companies. Now, if two countries use two different accounting standards, right, then you cannot compare the financial statements of the businesses in those two countries. Like we can't compare the financial statements of a company in Sri Lanka with the financial statements of a company in America, because America, like I said before, follows US GAAP, not international accounting standards. But of course, the fact that a lot of countries are using international accounting standards, because a lot of countries develop their standards based on the international accounting standards, comparability has improved over the years. Right. Last, estimated values. Some accounting standards require estimates and judgments to be made, right? The simplest example would be, I'm sure most of you would get this, under LKS 16, we know for property, plant and equipment, when we are depreciating, we need to estimate the useful life and the residual value of property, plant and equipment. Those are all estimates. We don't know for sure. So the managers, the accountant has to guess or to predict those values. So when you are doing accounting, you have to do a lot of predictions, you have to do a lot of estimates, which might not be correct. So that's another limitation of financial statements. Now, even under this accounting standard, LKS 37, provisions, contingent liabilities and contingent assets, you have to estimate the value of provisions like the warranty provision. They are not perfect estimates because we don't have all the information to accurately estimate. So we have to just predict. They can be right or wrong. Right. Then we are going to look at corporate governance, right? So I already explained, when you take a company, the company is not managed or a company is not run by the shareholders. The shareholders of the company own the company, but they don't manage it or they don't run it, right? They appoint a board of directors and managers to manage the company on their behalf, right? So the board of directors will manage the company on behalf of the shareholders, right? So because they have to manage the company on behalf of the shareholders, the board of directors are accountable to the shareholders. So accountable means not just responsible, but the directors should also answer for the results achieved by the company. They have to give reports to the shareholder explaining their decisions, explaining their actions, right? So accountable is much more serious than responsible. When you're responsible, you are just given the duty to do a particular task. But when you're accountable, you are given the duty to do a task, but you also have to give a report of what you did. You also have to answer for the results achieved, right? So that's what board of directors have. Now, the problem is that the company is owned by the shareholders, but it is managed by a board of directors. So then how do we ensure that the board of directors manage the company in the best interest of the shareholders? Or simply put, how do we ensure that the board of directors run the company, manage the company in a way that is going to benefit the shareholders? Why? Because now directors, because they are managing the company, can manage the company in a way that will benefit them, not the shareholders. So we need some kind of mechanism to ensure that the directors manage the company in a way that will benefit the shareholders, not just the directors, right? So we need a system to ensure that the directors manage the company properly in the best interest of the shareholders. So that's what corporate governance is. So corporate governance is simply the system by which companies and other entities are directed and controlled. So it's a system of checks and balances. It's a system of different things that can be used to ensure that the board of directors and managers of the company manage the company in a way that will benefit the shareholders. So good corporate governance is important because the owners of the company, the shareholders, and the people who manage the company, the board of directors, are not always the same. So this can lead to conflict of interest. There's a conflict of interest because these guys, like I said, will try to manage the company in a way that will benefit them, not the shareholders. Managers and board of directors are accountable to the shareholders for management of the resources under their control and the performance of the company. Right. One way of ensuring companies manage in the best interest of the shareholders. Now, what do we mean by best interest of the shareholders? That means the company is managed in a way that will benefit the shareholders, not the board of directors. So one way that we can make sure the company is managed in the best interest of the shareholders is by periodically providing financial statements to shareholders. So one way that the directors can show that they are managing the business in a way that is beneficial to the shareholders is by periodically, right, annually, semi-annually providing financial statements to the shareholders, because through the financial statements, shareholders can evaluate how well the board of directors are managing the company, right? Okay. Then the legal responsibilities of directors. Directors have a duty of care to show reasonable competence and may have to indemnify the company against losses caused by their negligence. So directors have a duty of care, meaning they are responsible to behave like a reasonable person. They should not behave recklessly, and they should also show reasonable competence. They should need to show that they have the skills and knowledge to manage the company, and they also have to indemnify, meaning pay compensation to the company for any losses that are caused by their negligence. So directors have to really make sure they manage the company in a competent, in a responsible manner. And if losses arise to the company, if losses are created for the company because of their negligence, because of their recklessness, right, the directors have to pay compensation to the company. Directors are also said to have a fiduciary position. A fiduciary position or a fiduciary duty means the responsibility to act in the best interest of someone else, right? So the directors have a fiduciary duty because they should behave, they should make decisions that will not be in the best interest of themselves, but in the best interest of the shareholders. They should not focus on taking actions that is best for them. They should focus on taking action that's best for the shareholders. Directors are also said to be in a fiduciary position in relation to the company, which means that they must act honestly in what they consider to be the best interest of the company and in good faith. According to Sri Lanka Companies Act number 7 of 2007, directors should act in good faith, meaning they should be honest and sincere and in the interest of the company, comply with the Companies Act and Companies Articles. What are Companies Articles? Companies Articles are the Articles of Association. That's the constitution of a company. Each company is required to have Articles of Association. It is a document with the rules and regulations of the company. Not act in a manner which is reckless or grossly negligent. Exercise the degree of skill and care that may be reasonably expected of a person of their knowledge and experience. So directors need to have the skill and the knowledge that can be reasonably expected from someone with their knowledge and experience. Right. So legal responsibility of directors continuing. An overriding theme is the principle that the purpose of the legal framework surrounding companies should be to help companies do business, right? So all these rules and regulations that are there for companies is there to help the company do business. Directors' main aim should be to create wealth for the shareholders. So normally it is understood that the main responsibility of the directors is to create wealth or create profit for the shareholders. But now of course we are not just going to focus on the shareholders, right? We are going to extend it to stakeholders. We know more than shareholders, we also have to look at other people who are affected by the business. So we are not just managing the company for the interest of the shareholders. We have to also pay attention to how the company will affect other stakeholders like the employees, customers, the government, the public, and so on. In a sense, this principle means that the law should encourage long-termism. So all the rules and regulation, right, including corporate governance, should encourage directors and managers to take a long-term perspective. It should encourage them to think about the long term rather than about short-term profits. And regard for all stakeholders. So all stakeholders need to be considered by directors. And that stakeholder interest, not shareholder, stakeholder interest should be pursued in an enlightened and inclusive way. So all those big words, right, what they mean is now companies should not just focus on generating profit for the shareholders, but they should also focus on making sure the interest, the goals and objectives of other stakeholders are also achieved. So they need to pay attention to other stakeholders also, not just to shareholders. When exercising this duty, directors should consider consequence of decisions in the long term. So directors should always think about the long-term consequences of their decisions. They should not just focus on short-term profit. Interest of their employees, the need to develop good relationships with customers and suppliers, the impact of the company on the local community and the environment, the desirability of maintaining high standards of business conduct and a good reputation, the need to act fairly as between all members of the company. So these are things that the directors need to consider when they make decisions. Right. Then responsibility for the financial statements. Now, who in a business, who in a company is actually responsible for the preparation of financial statements? Is it the accountant, the finance manager, the CFO, the CEO, or the directors, right? So, directors are the ones who are ultimately responsible for the preparation of the financial statements. Of course, in most companies, directors, they themselves will not prepare it, the accountant will prepare it, but it's the directors who are ultimately responsible. It's the directors who have to sign the financial statements. So, the ultimate responsibility about the financial statements lie with the directors. Directors are responsible for the preparation of financial statements of the company. Specifically, directors are responsible for preparation of the financial statements of the company in accordance with applicable financial reporting framework. So what that means is accounting standards and whatever other rules and regulations. Internal controls necessary to enable the preparation of financial statements that are free from material misstatements, whether due to error or fraud. So the directors are also responsible for making sure there are internal controls like double checks, right? Then segregation of duties, physical security, and so on. So you learn about internal controls in a different subject, but the idea is that there needs to be certain mechanisms to ensure everything is done properly, and ultimate responsibility for that is also with directors. So a simple internal control would be segregation of duties. For example, in a company, if you want to make a payment, right, the payment has to be approved by one person, the check will be written by someone else, and lastly check will be handed over by someone else. So there are three people in that task, right? So by making sure the task is broken down into smaller tasks and performed by three individuals, right, the chances for fraud, right, will be minimized. So that's the internal control. The prevention and detection of fraud. So directors are also responsible for preventing fraud and detecting fraud, including theft, right? Ensure that the entity complies with relevant laws and regulations. So ultimate responsibility for making sure that the company follows the rules and regulations also lie with the directors, right? So for example, if the company is violating the Companies Act number 7 of 2007, right, the penalty will be on the directors, not on the managers, right? Even if it's a manager who has done the wrong thing, it's the directors who are ultimately responsible for making sure the company follows the relevant rules and regulations. Right, so the role of a professional accountant. So if you're a chartered accountant, for an example, you can work in public practice, meaning you can work for a firm that provides professional services like an audit firm, or you can work for a business directly, like for example, you can be the accountant in a manufacturing company. So if you work in public practice, you will have multiple clients. You will have a single employer, but you'll have multiple clients, right? And you will be responsible for preparing accounts for those clients, auditing their financial statements, and providing advice to those clients. Whereas if you are working for a particular business, you are responsible for preparation of financial statements of that business, right? Either way, a professional accountant should make sure that through financial statements, fair and honest financial information is given out, right? They should always act in the best interest of the public, right? Even though they are working with a client, even though they are employed by a particular employer, right? The professional accountant should always take decisions, should always do things that will be beneficial to the society as a whole. Because a lot of people in the society, right, people outside the business, rely on the financial statements prepared by professional accountants to make decisions. So then the professional accountants need to make sure that they are fair and honest and provide fair and honest information through the financial statements. Sometimes that can result in a disadvantage to their client or the employer, but that doesn't matter because professional accountant should always make sure fair and honest financial information is given out. So then, professional accountant therefore needs to be very ethical. Professional accountant has to behave in a manner that is very ethical. So that's why CASriLanka has introduced a code of ethics for professional accountants. So a list of ethical principles have been introduced by CASriLanka which a professional accountant needs to display. So before we look at that, let's read this paragraph. Professional accountants must therefore behave in an ethical manner at all times. Professional accountants must put the needs of third parties ahead of their personal needs and the needs of the organization whose accounts they are preparing or auditing. So again, always they need to pay attention to what's best for the public rather than for themselves or for their client or the employer. Right. So the ethical principles are integrity, which means honesty, sincerity, right? Objectivity, professional accountant should be unbiased, should be impartial. Professional competence and due care. So the professional accountant should have the skills and the knowledge and needs to be careful, should not be negligent, should not be reckless. Confidentiality means the professional accountant needs to respect the privacy and the confidentiality of the information that they get when performing their work. Professionalism, so the professional accountant should behave in a professional manner, should show professional traits like being respectful to others, right? So all these ethical traits should be there in a professional accountant. So ethics for accountants is very important because the work performed by accountants are relied on by so many people to make economic decisions. So therefore, it's important that accountants behave in a manner that is ethical. So consequences of unethical behavior. Now in the last 20 years, there have been so many incidences where professional accountants have behaved in an unethical manner, right? For example, corporate scandals including Enron, Lehman Brothers and Olympus corporations were all due to unethical behavior of accountants, right? So when you behave unethically, some of the consequences can be the downfall of the company involved. Obviously, that's what happened with Enron. The company had to be closed down. At the time it was closed down, it was valued as one of the most valuable companies in America, but due to accounting malpractices, right, it had to file for bankruptcy, it had to be closed down. Then a professional accountant that behaves unethically can have legal action taken against him or her, civil or criminal charges against both the firm as well as the individual accountant. And then the membership to professional organizations can be revoked or suspended. For example, if CASriLanka finds out that an accountant has been behaving unethically, the membership can be suspended or revoked. Then development of the accounting profession, the last bit, right? So accountancy is a highly dynamic profession. It's a highly dynamic knowledge area. It's something that changes all the time, right? Accountancy changes all the time. So two of the most recent developments in the accountancy profession are globalization and technology, right? So let's look at globalization and how it affects the accountancy profession. So due to globalization, there are so many multinational organizations or multinational companies. So multinational company is a company that has operations in more than one country. If you take Unilever, right? Unilever operates in more than I think 100 countries, right? McDonald's also operates in so many countries. So all those are multinational companies, right? So if an accountant is working for a multinational corporation, the accountant or the auditor of those multinational corporations need to be familiar with GAAP or the accounting standards of those different countries, because you need to be familiar with those accounting standards to prepare individual and consolidated financial statements. Then if you are operating in multiple countries, that means you are also doing transactions in different currencies. So then there's another problem there. Multinational companies especially can have transactions happening in multiple currencies, and then we have to convert them into a suitable currency to prepare the financial statements. There's a separate accounting standard that tells us how to account for transactions that are done in a foreign currency. For example, if a US dollar transaction happens in Sri Lanka, how do you account for it? So there's a separate accounting standard for that. Another challenge is the need to report in different currencies. Like I said, the financial statements of subsidiaries must be translated to the reporting currency of the consolidated accounts. Now, if let's say a company in Sri Lanka has a subsidiary in America, then the subsidiary in America will have financial statements made in dollars. But then the parent company, which is in Sri Lanka, will have the financial statements made in rupees. So then those dollar financial statements have to be converted into rupees before they can be combined, or before consolidated financial statements can be made, right? So now don't worry too much about consolidated financial statements. You will learn that later. Accountants working for multinationals also need to be aware of other local differences in compliance, such as taxation, company law, and data protection. So different countries will have different rules and regulations on taxation and general company law. So an accountant working for a multinational corporation needs to be aware of all those differences. Then the impact of technology on accounting profession. Now with multinational corporations, right, generating a lot of financial data, and not just multinational corporations, any large corporation generating a lot of financial data, the accounting systems that need to keep track of all those data and all those transactions are complex. So accountants need to be knowledgeable. Accountants need to have the skills to use all those complex accounting systems. Now most accounting happens through a computer, right? We no longer keep accounts in books, right? We don't physically keep accounts. All accounts happen via a computer. So an accountant needs to have basic and even advanced ICT skills to be able to do his or her job. So if you are an accountant in a large corporation that uses an ERP, enterprise resource system, right, you need to obviously be familiar with that ERP in order to use it for accounting, right? So you cannot simply say that I don't know how to use a computer anymore, because the role of an accountant involves using the computer and using complicated accounting softwares and systems. So an accountant nowadays need to be fully aware of such ERPs and should be able to use those ERPs and other accounting softwares. Then there are other problems like Bitcoin and cryptocurrencies, right? So new accounting systems will have to be developed to account for Bitcoins and cryptocurrencies. What are the accounting standards relevant for Bitcoins and cryptocurrencies, right? So all those are new areas in the accountancy profession due to development of technology. It is likely that accounting standards and other regulations will become more complex in order to be applicable to new technologies. These changes will bring both challenges and opportunities to the accounting profession. So as technology develops, right, it creates challenges, right, as long as you don't respond to the change in technology, right? So the best way is when technology changes, you should also change. You should embrace technology. You should teach yourself how to use new technology. Otherwise, it becomes a challenge. So with technology, if you handle it properly, it can be an opportunity, right? So accountancy profession is greatly affected by changes in technology, right? So that brings us to the end of this video. So in this video, we learned what is financial accounting, why it is important, what are the financial statements, who uses those financial statements, then the different rules and regulations we need to follow when preparing financial statements. We looked at why it is important for accountants to behave ethically, and lastly we looked at a couple of new developments in the accountancy profession, the impact of globalization and technology on the role of an accountant in business, right? So thank you for watching this video.